Financial markets are forums in which suppliers of funds and demanders of funds can transact business directly. That is, firms do not have to go to banks and financial intermediaries to obtain funds. They go directly to the suppliers of the funds. Transactions in short-term marketable securities take place in the money market, while transactions in long-term securities take place in the capital market. A private placement involves the sale of a new security directly to an investor or a group of investors. However, most firms raise money through a public offering of securities, which is the sale of either bonds or stocks to the general public. The primary market is the financial market where new securities are initially issued. This is the only market in which the issuer is directly involved in the transaction, whereas secondary markets are financial markets in which pre-owned securities, those that are not issues, are traded. So in the primary market, on the equity side, we'll have the initial public offering when firm shares are sold publicly for the first time. We can also have seasoned equity offerings where existing firms issue new shares. We can also have new bond issuances where companies raise bonds in the primary market. We can think of the primary market as the market for new securities, and secondary markets, kind of like cars, the market for used securities. So if you've ever bought or sold stocks on the NASDAQ or the New York Stock Exchange, or you open a brokerage account with Charles Schwab or some other online broker, you've been buying and selling stocks in the secondary markets. When you buy that stock, the seller of the stock is another investor, and the original issuer, the company whose stock you're buying or selling, does not share in those proceeds. The money market is created by a financial relationship between suppliers and demanders of short-term funds. Most money market transactions are made in marketable securities, which are short-term debt instruments, and these include U.S. Treasury bills issued by the federal government, commercial paper that's issued by businesses, and this will be very large businesses with excellent credit ratings, and negotiable certificates of deposit issued by financial institutions. Investors generally consider marketable securities to be among the least risky investments available. The capital market is where firms obtain external long-term financing. Keep in mind that firms can also obtain long-term financing via internally generated funds. Internally generated funds are retained earnings, that portion of net income not paid out to investors through dividends or stock repurchases. The capital market enables suppliers and demanders of long-term funds to make transactions. The major capital market securities are bonds and stock, both common and preferred. Bonds are long-term debt instruments used by businesses and governments to raise large sums of money, usually from a diverse group of lenders. Firms issue bonds because they're less expensive than loans from financial institutions. However, only larger firms can issue bonds, and we will discuss bonds in much more depth in the bonds and bond valuation section later on in the semester. Common stock are units of ownership, interest, or equity in a corporation, while preferred stock is a special form of ownership that has features of both bond and common stock. We think of it as a hybrid security. We will discuss common and preferred stock in much more detail in the stock and stock valuation section. You can purchase shares of Berkshire Hathaway stock in the capital market. It's a New York Stock Exchange listed stock. But be prepared to write a big check. Since the early 1980s, Berkshire Hathaway's Class A common stock price has climbed from $280 a share to a staggering $246,000 per share. The company is led by Chairman Warren Buffett and Vice Chairman Charlie Munger. Berkshire Hathaway Class A shares have never been split. Why might the company refuse to split its shares to make them more affordable to average investors? Let me give you a hint. Read Warren and Charlie's letters on Berkshire Hathaway's webpage. These letters are widely followed and are extremely entertaining as well as informative, and give insights into the thinking of two of the most successful investors of all time.